Just waiting on a few more people to come in. Welcome everybody who's here. Hopefully you guys see our mid-year market report. And the main question is, how is your money doing? That's more important always. So just give it a second. It's great that, such great amount of people join us with all your years of wisdom and curiosity to continue to learn, which is great. I appreciate everyone who's chosen to spend part of their afternoon invested with us here to discuss the art of securing your financial future to be robust and worry-free. I mean, we're here to help you get there. We do more for your money today, tomorrow, and we do it together. So if anyone ever has any questions, you can always call us for your free review. Again, before we dive in, as I'm waiting for a few more people to join us, I want to share a little story that gets to the meat of the matter. There was an investor, he kept all his money in the freezer. Anyone know why? By the way, this gives you a good chance to say, if you want, you can chat at the bottom, or there's Q&A at the bottom. So if you have an answer, you can always put it in the chat and Q&A. But again, it's why the investor keep his money in the freezer? Well, obviously he wanted cold hard cash. All right, so again, mid-year market review, how's your money doing? That's really the key here. So thank you everybody for joining us here today. And again, if you have any questions, comments, there's a chat or a Q&A, just put that in there and I'll read your question. And if we get into it, I'll tell you we'll get to it. All right. So why is this important? Why is it important to know how your money is doing? Or why is it important to have a mid-year market report? Why is it important to spend your afternoon with us? I mean, geez, you guys already have money. What's the story? Well, here's what's important is 45% of baby boomers, the largest generation in the history of America, 45% of them have no savings, right? None, 45%. And of the 55% that do have savings, 28% more have less than $100,000 saved for retirement to their name, less than $100,000. So you're looking at around, mathematically, 60% of baby boomers have $100,000 or less. And there's that old saying, when you have nothing to lose. Well, a lot of those people don't have as much to lose. I mean, you guys have a lot to lose, so it's important to educate yourself, ask questions, get reviews, take advantage of these free offers that we or another advisor is offering to give you a second free look with no obligation. You can call our office, 949-219-0692. Again, 949-219-0692, or respond to the email that you receive inviting you to this webinar. And we'll be happy to take a look at it. I'm going to tell you, I had one of my neighbors, and I live in a very nice neighborhood, and one of my neighbors, turns out, came up to me and he was looking for a job not too long ago. And I was like shocked, because this guy went to USC and, downtown LA. And then back when he graduated, around the same age, he got a job at the Pacific Stock Exchange. For those of you who remember that far back, like I do, off the 110 freeway, right before you got to the 101, right across from downtown Los Angeles, was this big long building called the Pacific Stock Exchange. And so he'd worked there until he was in his young to maybe mid-40s. We did like all these, YMCA group things with his kids and my kids. And about 44, 45 years old, this guy retired and started just trading on his own, day trading. Okay. But he knew what he was doing because he worked on the Pacific Stock Exchange, and it's a different methodology. And he was able to not only pay all his bills, he moved into an even nicer neighborhood than ours, like upgraded. He had 3 kids in private school and college. He was doing well to pay all the bills. But about 3 years ago, he came up to me and said, this isn't working anymore, with the AI and all the other sort of stuff, the high speed of it all. He couldn't get the spreads because he was doing this specialty thing. I understood what he was doing, but it was like really trading spreads, if you will, fractions of a point, high volume and all this and that. But he was successful at it. He said, I got to give it all up. So when he gave it all up, what he did is he found this real estate investment, not a club, but REIT, if you will, private placement, just a couple of brothers that ran it. And he gave them all his money. All except for his house. And they went BK like last year, totally lost everything. The brothers split up and all this and that, in terms of working together, and they're suing each other, and basically there's nothing left. Because he didn't educate himself on diversification. He did one thing, traded it really well. When he gave that up, he just went all into one. I mean, we didn't talk about his investments. He was my neighbor. I'd let people call me. Hey, look, I'm never going to bother you guys. If you want to have me review it, you can call me, 949-219-0692. But that's why this is important. You got to know how your money is doing. You should be checking on it, at least monthly. Talk to your advisor. We're not calling you, call them. Say, hey, I need to get on your schedule. Have a talk, have it reviewed. Because, it's really important to know how your money is doing besides the market. The market's doing good. I mean, let's get to that. But how are you doing, not relative to the market, but relative to the things that you need to accomplish in your life? So hang on here for a second. I got to get into another screen. Here we go. Bear with me a second. I apologize. Let me try this again. You'd think I'd figure this out eventually. Here we go. I've got it. So here's the S&P 500. All right. This was January 1st right here, December 31st, or 30th, I guess, was the end of last year. That little box says that it was 38.39 at the end of the year. That's where the S&P concluded, 38.39. Now, I don't know if you guys want me to do this today or to mid-year, but if I do it to today, we're at 45.67. So that market's up 18%. I mean, this run has been nothing less than phenomenal. Now, really, most of the run has happened basically since the beginning of June, right there. Because if you look, the market was mostly going sideways earlier in the year, and not so much down here, but it was getting stopped the same place it stopped in late January, early February. It got stopped again in April. It got stopped again in May, and it hung around there till early June. And you can see here's when June, the market started taking off. If you look at the Dow Jones Industrial Average, it didn't do as well initially. Matter of fact, the Dow, if you look at it, that's only 30 companies. On December 30th was right there, 33,147. And literally it was at 33.7 here on July 10th. I mean, just hadn't made much money. 33,700. It was up 600 points. It's less than 1%. But look at this run that we've been having lately. And people ask me why. Why is there a run? Why is that happening? Well, I think what we're starting to understand is the economy is slowed down, okay? The economy is slowing, but it's not crashing. And there was so many people after the bear market last year, where the S&P lost 27%, and the Dow lost, I'm sorry, and the NASDAQ lost 37%. That was just absolutely horrible, right? Now all of a sudden everyone's predicting, okay, it's going to be a recession, it's going to be a recession, it's going to be a recession. Yet the markets are rallying because it does not see it being as bad as the media make it sound, or people for political purposes make it sound, or whatever it is. That's kind of what's going on, is that it's not as bad, and earnings are coming out quite well so far. And in the end, the markets are holding, and not only holding, but doing well, because inflation, that's the rising cost of living, is slowed from almost 10% last year to between 3 and 4% this year. Now, I know the Fed keeps saying they want 2% inflation, but historically, if you go back the last 50 years, historically, inflation somewhere between 3 and 4%. What we saw between 2010 until basically the end of 21 was kind of the anomaly, where we had these low cost of living increase years, low inflation years. But people ask me another question. They say, well, how is it that that you are saying that inflation's going down? My prices are still up. Yes, they are. So if you spent $1,000 basically on 1/1/22, all right, 18 months ago, by the end of last year, with a 9% inflation rate, 9.1 actually, it cost you almost $1,100, let's say 10% more, to buy the same goods. This was your cost of goods. So you spent $1,000 in January. By December 31st, that same basket of goods cost you $100 more to buy the exact same thing a year earlier. So now they're saying, okay, inflation's slowing down to, let's say, 4% by June 30th of this year, 23, all right? So does that mean that, okay, prices went down 5% from 9% to 4%? No, prices went up 9% and then they went up another 4%. So now it costs you $1,140 to buy the same cost of goods, the same amount of gasoline, lipstick, groceries, etc., whatever it is you bought for $1,000, it now costs you $1,140. But the cost rate, instead of going up by $100, has slowed down to a rate of only maybe $40. So people feel good about it. But either way, if you're on a fixed income, you're still spending $1,140 for what cost you $1,000 a year and a half ago. And for many of you, you know, your costs are still rising even faster than that. So you know, it's important that we got to try to keep up with inflation. So people ask me all the time, Jerry, you know, I know you've used these money markets that are paying 4.7%, 4.8%. And I know you've been buying this treasury bills that are paying 5.2%. How is that keeping up with inflation? Well, inflation now is 4%. So if you're getting 4.7 or 5.2, you're not only keeping up, you're ahead of inflation. So they go, well, Jerry, what about last year when inflation was 9% and I only returned, let's say, 4.5%? Didn't I lose behind 4.5%? Yeah, you did, but you kept all your money intact. Now, let's look one more time at how that looks, because inflation doesn't just affect when you have T-bills and money markets. If inflation is 9%, okay, and you only earn 4.5%, so this is -9 plus 4.5% growth from your T-bill, you are still down 4.5% on your costs in 1 year. But last year, didn't the stock market go down by 20% by the S&P 500? Didn't that happen? So if you have -9% and minus 29%, your useful cost of buying, purchasing power went down 29%. So whether you're earning something safely, 4.5%, and not losing your money, or investing it with risk and losing your money, you would have been much better off to be down 4.5% than down almost 30%. Hopefully you follow that, because that's a real loss there. So now people are saying, I just said the S&P is up 18%. Okay, so let's take a look at how that works. Okay, so at the beginning of 2021, because I want to show exactly what I just did, I want to show you this inflation track one more time. So at the beginning of 2021, the NASDAQ, the S&P was 36,338. So 36,338. Okay, and then this is the S&P 5. Oh, doggone it, I'm wrong. I'm sorry. Scratch that. That was the Dow. I didn't want the Dow. The S&P was 4818. There you go, 4818, and that was on 1/1/22. It finished the year. I've already said this once, but I'm gonna have to just look at it again. It finished the year at 3839. So 3839. That's going to be down, I think, 18-19%. So 4818, 3839. Yeah, 4818, 3889. Mark, if you're on here, sorry about that. You're down 19%. Okay. And didn't I say that it's up 18% year to date? And I did, because it was 3839 and now it's 4567. Well, wait a minute. It was 4818 and now it's 4567, and this was down 19% and this is up 18%. Shouldn't it be a lot closer than that? Well, that's the law of inverse math. See, to get back from 3839 back to 4818, you would have needed a return of 25%. See, when you lose 19%, you have less money to compound. If you only get 19% or 18% on 38, 39, not the same as losing 19% on a bigger number, 48, 18. So even though the markets have come back 18%, you're still down year to date. I mean, well, on a 2-year basis, because you're down 25%. You need 25% to break even from last year's midterm number. So that's why it's important to not lose. Now you subtract 9% inflation off of that. And so instead of being down 19%, you would have been down 28%. And again, if you want to get back to 100% at 72, you would have needed a 38% increase just to get even with inflation from last year. This is a real number. So people who got the S&P return lost 19% last year, and inflation last year needed 38% to break even. And they're only up 18%. So after inflation, they're still really down. That's why with being only down 4.5% to inflation by using something safe still makes a lot of sense. All right. Again, if anyone's got a question, you could go into the chat button or Q&A. Be happy to take anybody's questions or comments or anything along those lines. So, but it is important to know how you stand. But what's important to understand how you stand, where you stand, is relative to yourself. Once again, if you look at it, people are wondering, how do I get real rates of return? Well, we've talked about this before. There's total return comes from two things: income and growth. And the growth is predictable. The income is not. I'm going to show you that one more time here. If you look at it, people want to get returns. What they look for is something called total return. It comes from income, which are dividends and interest, or growth. So you got the dividends, you have interest here. This is predictable. This is more certain. You can, yes, do stocks cut some dividends? Yes, but you can see it happening. This, as we saw last year, is uncertain, the growth portion. The growth, as we saw last year, can become a loss. And so people think, well, if I just invest for income, I can't get the returns. Yes, you can. You can get those returns and better, because this one here, if you have a loss to overcome, as I just showed, when the market was down 20%, and now we're up 18, it's not like you're still down only 2%. You're down significantly more because you needed 25% to break even, the law of inverse numbers. And then there was also, you needed the 9% inflation to overcome. You're still down another 18% on your money if you were in this unpredictable growth versus losses, where if you're trying to get dividends and income. And I'm not saying all growth is bad, but this is the safer way to go. This is the plan that will help get you back to where you need to be. And if you're retired and you're giving up your paycheck, then you really need the importance of having a strategy like this. In addition, there's risk management strategies. Hang on, I didn't need to come back to me right here. So here is your asset allocation of traditional stocks, how much you have in the stock market. Hang on here for a second. There we go. Okay, here's your normal asset allocation: stocks, bonds, cash, and alternatives. And alternatives came around about 20 years ago. And, advisors go, well, we've got you in a 60-40, 60% stocks, 40% bonds. Well, they didn't really probably have you in bonds. They had you in bond mutual funds or ETFs that are bond oriented. And those, I'm still warning people to stay away from those, because they may never come back to those levels that they were a couple of years ago, when interest rates were at less than 1% on a 10-year treasury. And then alternatives, they're hybrids. They could work. They really are. But really, for most residents, my type of clients, residents, what you want to do is figure out how much is safe versus how much of your money is risky. This is a better asset allocation. Now, within the safe, those are banks, bonds, insurance companies. We've talked about that. We have in the past. Within the risky, that's your traditional asset allocation: stocks, bonds, cash, and alternatives. So what's really important, especially as you get closer to retirement, which most of you on this call are getting closer, at least towards your retirement. Many of you are retired. You want to know how much your money is at risk. How do you want all of it at risk? Do you want none of it at risk? Or do you want some of it at risk? And so that determination will determine how you go. But I meet people all the time who say, "Oh, I'm extremely conservative." And I look at their portfolio and it's 80-90% in the stock market, even if it's stock mutual funds. And they say, "Well, I only own blue chip stocks." Well, on the scale of no risk to high risk, they're on the high risk side, but they're on the safe stocks of the highest risk of things you can do. And many of you don't know how much risk you're taking, and that's probably an analysis. You're kind of utilizing a benchmark. That benchmark is how much my money is guaranteed and how much my money has risk. And then figure out how much you're willing to take with that risk. Is it, are you pedal to the metal all the time? Or are you trying to get, like I said, more income oriented to try to keep up with inflation and beat the banks? When you retire, if you haven't saved your money yet, it gets a little harder to say, "Hey, I need to still grow my money." Talked to a woman today, 72, and she's still working. And her husband's deceased, and she says, it was good use of her mind. And it was, it is. And she has a 401k and wants to continue with it. I was wondering if she should roll that over. And I said, "Well, if you hit 73, then you're going to have to start taking the RMD. But if you continue to work, you won't. So there's better taxation for you if you don't." So not all advice goes the same for everybody. That's not one hat fits all. So you'd have to determine how much risk you want to take. It's an individual question. And some of you are all of it. I mean, I know people that say, "No, I want all my money at risk." Okay. And some other people are like, "Hey, I want none of it at risk." When you probably should have some, but it really comes down to how much income you drive. It's always about the income. It really is. It really shouldn't be. So many advisors that when they approach it, they say, "How much risk do you want to take?" What I try to do is solve for income. How much sustainable income do you have coming in today? How much do you need? Is there a shortfall? Can we bump that up? Can we bump that up to another level? So, I mean, that's what's important. Is just I want to make sure each one of you, build on these concepts and insights and strategies that I discussed. But it's a discussion that I don't want it to fade away when you walk out the door. But what I'm offering is a retirement risk report that will show you. It's a comprehensive report that's tailored specifically for you individually, because everyone's going to be different with these questions that they're going to answer. And looking at your portfolio, it's going to be unique to your circumstances, needs, and financial goals. But it's a roadmap about income. It's not a roadmap about how much risk you should take or what, how you should really be balanced. It's retirement planning, but pinpointing potential pitfalls. And the main pitfall is, where is your income going to come from if you give up your paycheck? If you've already given up your paycheck, is that income sustainable with inflation for the rest of your life? And then how long are you going to live? Because you want to enhance your financial security. So I'm not just offering an assessment. It's a dialogue. It's an opportunity to ask questions, express concerns, refine your strategy, designed around that TR equals I plus G. Is how much I do you actually need? I have some clients who don't need any. Most of my clients are just average mom and pop that need to replace at least part of that, because Social Security isn't enough. Some of you have Social Security and pensions. It's not enough. I have some people that have pensions that are more than enough. I have other people that have other assets that are more than enough. But depending on where you are, this retirement risk report is for you, because it'll give you a guide. It's an essential tool to take theoretical knowledge that you're spending your time on today, to put it into practical knowledge for yourself, your own application. That goes back to the very first slide I had, is how are you doing, as opposed to the mid-year market report. Okay, yeah, asset allocation is important, stocks, bonds, cash, but a lot of advisors switched bonds for bond mutual funds. They talk about bonds. Oh, when you get at 60 years old, you should have 60% of your money in bonds. That's the old strategy when I first got in the business 35 years ago. But, it's not that today. But at the time, the more fixed income you have, the more conservative your portfolio is going to be, because fixed income, as I pointed out, is predictable. The market is not predictable. So that's why these income strategies make some sense. But so if you don't need the income, you can reinvest and not take it, even if you don't need any current income. But if you do, then we tailor a portfolio based on needing your income. Now, if you don't have enough interest income coming in, and we squeezed every possible income out of your portfolio and it's not enough, that's when we start talking about, well, unfortunately, for your money to last your lifetime, you may have to take more risk. And we'd have that conversation. You still get to decide, because you may or may not run out of money. We don't know how long you're going to live. You may pass. You may live to 90. I mean, I've had different people that come to me in their senior years where I didn't, have to. None of my clients have been with me like for a long time, pre-retirement to through. Ever ran out of money. But clients that I've inherited, basically in their 70s or even in their 80s, I've had that conversation where they've run out of money. I mean, I've had that. I had one this year, not too long ago. It's a tragic situation. So it's important to get that, review. The retirement risk report is personalized. Let me know, 949-219-0692. Because there's tactical and then there's static investments. Tactical means, the world changes. The news is predicting bad news, and yet the market goes up like we've seen this year. And they're still predicting bad news, a bunch of people. I wouldn't be surprised to see us correct some. I mean, I really believe that will happen. We've got to go down a little bit. For those of you just waiting to buy, the bull market can outlast you, and the bear market can outlast all your money too. So don't think that, well, I'll just wait for it. You're better off having a strategy where you take shots at it, as you go. You don't have to invest all in one day. You take small portions over a period of time. That's the best way to get in. Getting out, you want to get out quickly. You want to enter slowly. It's a defensive approach to investing. But the markets have done well. But if you're not tactical with your approach, meaning that you have some sort of defensive mechanism to protect your risk money, okay, with bonds, you hold it to maturity. Let me go through that real quick here. Share this screen again. Is that with a bond, if you have an individual bond, there we go. You buy them at $1,000 a bond, and at maturity, the issuer guarantees you your $1,000 back. That's guarantee number one. It's the issuer. So if you're buying U.S. Treasuries, very simple. Those are the things that the Chinese governments are buying and the German governments are buying. They're very safe. The second thing they do is they give you steady income. The income that they give you is guaranteed by the issuer. So if it's corporate bonds, it's backed by the corporation. If it's municipal bonds, it's backed by a city, county, or state. If it's a treasury bond, it's backed by all the taxpayers. So this is guarantee number two, is the steady income. All right. So the defensive mechanism is because as interest rates go up, and the Fed's going to raise rates one more time, at least one more time tomorrow. They're going to say they might raise it again. The price goes down. And what we've seen over the last year is interest rates rise from 0 to almost 5.25%. Okay. So that was 0. And so that's a lot of raising in 1.5 years. That's one of the most aggressive rate hikes we've ever had. Generally, that kills the economy. We've seen the economy slowing. I still don't think it's going to die. So that means if you bought a T-bill, a year, T-note, because a bill is less than a year and a half ago, this thing would have gone underwater. The price would have been down, 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 down. But no matter what, if maturity was next week, it will come back and be worth $1,000. Only if you sold it early would you take a loss on an individual bond. But on a bond mutual fund, so let's compare this to a bond mutual fund, does anyone guarantee if you give them $1,000 that you're going to give them $1,000 back? No. Do they guarantee you a certain rate of income? A set rate like they do on an individual bond? No. So the two inherent guarantees of bonds are gone when you buy a bond mutual fund. A bond mutual fund, the definition is the stock of a company that buys bonds. All right. So Jane is asking me, is this a good time to buy treasury notes and bills? Yes, Jane, it is. Good question. Thank you very much. Yes, it is. Let me show you this. I had something else saved. There it is. Let me get this up here. Let me am I screen sharing with this? No, let's stop. Let me try one more time. New share. This is it. Okay, hang on. Maybe it did what I wanted it to do here. U.S. Treasuries. Okay, there you go, Jane. If you buy a 3-month treasury, you should be getting about 5.4%. If you buy a 2-year treasury, you're only going to get 4.89. What? You tying up your money for longer, you're getting less. You buy a 5-year treasury, you're only getting 4.16, and you buy a 10-year treasury, you're only getting 3.89. It gets less the longer you lend the money out for it. And you go out another fully out to 30 years, you're still getting less than you would for 3 months. So buying these short-term treasury bills makes some sense. At some point in time, we may want to extend the maturities, even if you say, well, Jerry, those rates are lower. Well, let me give you the scenario here. Is we are in what's called, I just showed it to you, an inverted yield curve where the close rates are 5.4 and the 30-year rates are 3.9. Like, you know, how is that? That is not normal. So normally we have a yield curve where lending your money to someone short term pays less than long term, but eventually there's a gradual rise, but it's always more at 30 years than, let's say, 10 years than 5 years, unless we have what's called an inverted yield curve, which is something we've had for over a year. So you could stay with these treasury bills and have getting 5.4% in a 4% inflation environment, Jane, and you're going to earn a real rate of return of over 1%. But the thought would be is these short-term rates will eventually come down, and these longer-term rates are either going to stay or maybe start to go up. So let me show you one other chart here, based still on Jane's question, because it was a really good one. Bear with me here 1 second. Oh shoot, I didn't mean to do that. So let me stop sharing. Give me 1 more second here. I gotta try this one more time. Goodness. There it is. Right? You see the S&P 500, right? Is that on there? Okay. 0TNX. This is the 10-year treasury rate. So you could see that last August of 22, the 10-year was still at 2.5%. And it went up to over 4.3% in a very short order. And then it's pulled back. But what I'm starting to see here is it looks like it might be breaking out. There's a chance that it holds right here. But to me, it looks like these interest rates are still going up. And why do I say that? Because if I look back further, now I'm going back when the interest rates were less than 1%, okay, in 2020, beginning of 21. And what we see is we had this big spike in rates last year, okay, huge spike in rates. And then it's kind of started to level off this year. And this is what I'm concerned with. Generally, when you get this kind of a pattern where it kind of eases in, where you have a high and a low and the lower high and a lower low and then a lower high, but it's now maybe a higher low, it's forming what's called a pennant. And if it forms this pennant and the trend ends, generally it's in the same direction as the initial move. The initial move was up, and that might mean interest rates go higher. So, long story, Jane, answering your question. I'd still stick on the short end of the market, less than 1 year. That may change, and we might extend the maturities at some point in the future. But for right now, I'd stay in the 3 to 6 month T-bill range because the money's safe, it's secure, and it's better than the rate of inflation. Anybody else have a question? Put it in the chat or the QA. I'd be happy to answer that. Thank you again for participating. So I've explained, understanding investment performance. That one other concept on that I want to point out is that you should, and if you're doing it yourself, you should. If you've got a financial advisor, you should call your financial advisor and ask them. But if I'm your financial advisor, you know I'm doing this. You should rate in the first, half of the year. We are still at the end of July. What are your best 3 investments on performance year to date? And what are your worst 3 performance year to date? If you only have 3 positions, it's a conundrum. But most people have, 15, 20. I see people with 100 and 150 different positions. You should know what are your worst ones and your best ones. Most firms like Schwab, E-Trade, Fidelity, Vanguard, they have these tools where you just press a button and you should be able to line them up, best to worst. Maybe from when you bought them, or you can set a selection of a date period of time, because you should know what's working for you today and what's doing bad, because some people still have positions that are still going down year to date or not participating at all in the up market year to date. So sometimes you use a garden. This is your portfolio, your stock and bond portfolio, compare it to a garden, okay, of roses or vegetables or fruit, whatever it is that you want in your garden. Most people, when they have gardens, if they have these weeds that grow in the garden, which invariably they do, this is high weed season, because of all the heat right now. As long as you're getting some water, they're going to be doing better than your plants. If there's no water, they'll be stealing the water from your plants, these weeds. So the point is they don't plant more plants around the weeds to hide the weeds. They pull the weeds and they throw them out. And what do you do with the money? Well, you can buy T-bill, or you could buy some other investments that are doing well, or some new investments that you hope will do well. So if you're not pulling the weeds to your garden, you're not a conservative investor. You're not a moderate investor. You're just let those dice roll and see what happens type of person. You may not think you are, but you are, because it's important. We talked about it. Why is it important? 60% of people have less than $100,000 to their names that are in the baby boom generation. A lot of those people are turning, 77 this year. Okay, how are they going to live? The 45% have nothing. Another 15% have less than 100,000. Wow. So make sure you're not one of those people. Pull the weeds in your garden. Okay, Jim, does this cause inflation with inverse rates? No, the inverse rates is trying to stop the inflation. The Fed did this on purpose. They can solve the inversion of the yield curve by cutting interest rates. But you're going to see the Fed Reserve tomorrow at 11 a.m. Pacific time. You're going to come on TV and they're going to say, oh, and the interest rate went up by another 0.25% tomorrow. What's more important than that, because that's a known, is what are they going to say? Are they going to say, we are going to be vigilant and we're going to do as needed? If there's something like that comes out, then that means that they're not dead set on raising it one another quarter. So that's what's important, what they say. Pretty sure that's something along the lines that they're going to be vigilant, they are going to remain open to raising rates, but they're not going to say we're definitely raising it one more time. If they do, the market will go down tomorrow, for sure. But that's not what's causing inflation, because as they raise those rates, Jim, what happens is the cost of money goes higher, meaning your borrowing costs. I will show that in a quick display. I'll check my time real quick. I think I have time to do this. So look, a year and a half ago, it cost you 3% to borrow to buy a home. All right. So I'm going to use a simple number because I live in Southern California. There's a lot of these $1 million homes. They're not much. They're $1 million homes. But that doesn't mean they're mansions. So that meant your cost of money from a banker that gave you that $1 million was $30,000 per year in interest. That was your cost of money. All right. Your cost of money. And so now mortgages are 7%. So that means it's $70,000 per year, not to pay down this $1 million, not to make one payment on it, because you got to pay that down. You want to eventually pay that off, to zero, right? This is just the cost for someone to give you the $1 million without paying it down. So your cost of money has more than doubled. It's whatever, 2.3 or something like that, right? 2.33%. That's a lot higher. It's more than double this cost of money. So people who could have afforded to buy $1 million home a year ago might say, we don't want to buy $1 million home at a cost of $70,000 a year. We got to buy a $750,000 loan, and they're still going to be paying somewhere around, $50,000, $45,000, $50,000 in cost of money for that loan, right? Still a lot higher than if they bought that $1 million home a year and a half ago. They're downsizing on home. So if they're downsizing on home, what does that do to the economy? It slows down the economy. They don't have as big of a remodel project. They don't have as many, the banker doesn't do as many transactions. So they lay staff off. They're not making as much money. So they lay staff off. They're not making as many loans. They're really looking at credit qualifications. So it doesn't cause inflation, these high rates. It actually is slowing inflation, which is showing that the Fed, this is weird for me to say, and anyone who's known me for a long time knows I'm always bashing on the Federal Reserve Bank, because it's not owned by the government. It's a private organization. A lot of people are shocked to hear that, but it is. And so they do what's best in their best interest. But this time, the economy has done well with this Fed chair. Why the transfer to Schwab? Okay, so people who are with me know that your accounts are going to be transferred to Schwab, but not really. Schwab already owns your accounts. TD Ameritrade got bought by Schwab 4 years ago. It was approved by the regulators about 2.5 years ago, and they're finally putting the two systems together. So we're already with Schwab, Jim. It's going to change the way their system and the statements and all that. They've created a new thing for the bigger dynamic firm. It's going to be a lot of fun, I promise you. I've been through this a bunch of times, but it's, the worst was when I was with Wachovia and they bought Prudential Securities from Prudential Insurance. The system shut down for a week. And that was in about 2002. Wow, it was a nightmare. Hopefully Schwab has it together as they integrate the two systems, but we're not transferring to Schwab, we're already with Schwab. Schwab bought TD Ameritrade 4 years ago. All right, let's continue on. Wealth preservation techniques, okay? So how do you do that? How do you preserve your money? Let's go back to the share and let's look at this. So you have the bonds I just talked about, those are guaranteed, right? There's also banks, they offer CD, okay, bank CDs. Those are also FDIC insured, okay? So then I talked about the bonds. They guarantee the principal and interest as long as it's an individual bond. And again, if you start buying corporate bonds, they, meaning that corporation, is guaranteeing it. That corporation's a junk bond or gets in trouble, that's how good your guarantee is. You start dealing with treasuries. Look, that's where the Chinese put their money, the Germans put their money. Everyone, that's the safest investment in the world, which is why our dollar historically has been strong, because we attract that money. And then there's annuities. All right, I've talked about these before. Some of you might be hanging up on me right now, but a lot of people just misunderstand that. The reason it's such a huge industry and the government just put annuities in there is there's two types. There's some that are what are called immediate, and that immediate means immediate income. So it's immediate income. They will pay you monthly for 5 years, 10 years, 20 years, the rest of your life. It'll pay whatever terms you set up with. If you win the lottery, that's an immediate annuity. If you win the lottery, you take the payment program. That's what that is. Some people go, I hate annuities. And I ask them if they have a pension. They go, yeah, I got a pension. That's an immediate annuity. It's basically what your corporation did. They went out and bought you an annuity, the exact same thing you hate. You hate them. I laugh when that happens. Because I meet people all the time. I go, do you like your pension? I love my pension. Yeah, well, I don't know. You kind of badmouth it a lot, don't you? No, I never do. Yeah, well, what about annuities? Oh, annuities, I hate them. Your pensions and annuities, an immediate annuity. It's a payout in that case for the rest of your life, and you could buy them where they pay for 5 years, 10 years. There's really good financial planning tools for those who need income. All right. Going back to it is there's also deferred annuities. The deferred means you don't need the income today. When do you take the income? Well, whenever you want to. I mean, you don't ever have to take the income. but there's three types. There's variable annuities, and these are the ones where people on TV saying, I would never buy an annuity. You know, they're high fees and all that other sort of stuff. I would never buy a variable annuity. I mean, years ago, that's all they had, but they've always had fixed annuities as well. Fixed right now, we can get you 5% for a 3 to 5 year range. So Jane, when you were talking about T-bills, I'm putting some of my clients in this 5-year fixed rate annuity, because if interest rates do crash back down, they're locked in for a longer period of time. Again, do we take all our money and do it there? No, just in little chunks. But those are backed by an insurance company who's reinsured by other insurance companies, and then that money is eventually backed by the state guaranteed fund. Okay, so that's a fixed annuity. That's the second kind. So 1, 2, and the third kind of deferred annuity is what's called an index annuity. So there's some people who should be in the market who like the stock market, but they hate risk. The beauty of an index annuity is it gives you upside participation when the stock market goes up. But if the market goes down, you do not lose. Market goes down, you get a 0. All right. And so you can get, I mean, can you get good returns? Yeah, I've seen these things return 25, 30% in a year. So people say, oh, they don't work. Yeah, they do. They work great. But are they as good as the stock market? Well, no, but there's no risk. With the stock market, there's risk. And these two have no fees. There's no fee whatsoever on most of your fixed or index annuities unless you start buying riders. Most of your riders don't work. They're not good. You don't want them. It's not in all cases, but a lot of riders, if you want the income side, buy an income annuity. If you want the growth, buy a growth annuity, and then switch later on to an income annuity. But there's growth annuities that put riders on it. So what do I mean? They're just not appropriate for certain people. I saw a lady recently, this became a client of mine, and her previous advisor just didn't understand their needs. They had no need for income, none. They have plenty of cash flow, and they've got a decent amount of capital that should last the rest of their life. So from a cash flow perspective, so we sold her an income annuity. That was complicated, riders and fees and all this other sort of stuff that they didn't need. So it's like going to a Ferrari dealership. You go in there and you say, I need a car to go to the mountains. And they say, okay, here, hold on for a minute. And they take one of these Ferraris in the showroom back, and they come back out and they say, look, we got snow tires on the Ferrari. We got a roof rack on the Ferrari so you can have your skis on there. I mean, look, it's not the car to take to the winter to, up to Tahoe or Mammoth. You don't want to be driving a Ferrari in the winter up there. It's not designed for it. You want an SUV, 4-wheel drive, bigger, safer. If someone says, hey, I need a winter vehicle, that's what you want. So it's the same with these annuities. Maybe you had a bad experience. Maybe someone, did the wrong thing for you or what have you. But these things are really good in the fact that they're safe, your money's secure, and you can get it with no fees and either get growth or income. Okay, got a couple more questions came in. Jane, again, if I make a good chunk of dividends with you and I keep my money with you, will I be paying taxes on the money I just paid taxes on? No, that's called double taxation. It's still not legal. No, now if let's say, let me use this as the example, Jane, just to make sure you see it, because your question makes it sound, will I pay taxes on the money I just made money on and pay taxes on? So let's say you have a $1,000 investment on a dividend stock that pays 10%. So it pays $100 dividend, okay? So whether you take the money out or not, this becomes taxable income, okay? So you got to pay taxes at the end of 2023 on this $100, okay? Whether you draw the money out or not, okay? So let's assume that you reinvested this dividend and now you have $1,100, and in 2024, okay, you make the same 10%, so it's $1,100 at 10%, means you're going to make $110. Now this $110 is a new $110. It's not that $100. So it's a new $100 on your $1,100. And do you have to pay taxes on that for 2024? Yeah, of course you do. you got to pay taxes on it. Now, there's something called qualified dividends versus ordinary dividends. And I think I talked about this last month or the month before. But at qualified dividends, most of your stocks on the exchange, a lot of things can become qualified dividends as long as you own it 60 days before it goes ex-dividend. And so sometimes our first dividend is ordinary, but a lot of things that we're trying to buy and hold have become qualified dividends where you're paying in the maximum 15% taxes on it. Now, if you're in the 0 to 12% tax bracket on your federal level, your taxes could be zero on your qualified dividends. So you got to just know what tax bracket you're in and some things like that. Again, Jane, something like that, we can look at your tax returns and I can help you, identify that. But dividends are taxed differently if they're qualified dividends, and the way we're always looking for qualified dividends. Not everything we do, but a lot of things. All right, Cindy, can you please display the white screen on annuities again so I can take a screenshot? Oh goodness, I hope I didn't mess that up. Sure, let me go back to that while we talk here. This wasn't it. This one? Yeah. And again, Cindy, if you want, we could do a one-on-one and a Zoom call, and I could do this. But these are your insured deals: banks, bonds, and insurance companies. Insurance companies offers annuities. There's immediate annuities for immediate income. You want to boost your income, convert some of your money to start paying your monthly. Then there's deferred, there's the variable, there's the fixed, if you can read that. These rates are around 5% right now. And then there's the index annuities. As long as you don't throw riders on there, there's no fee, and they offer guarantees of principal. With a fixed, you're going to guarantee a principal and a guaranteed rate, much like you do with an individual bond or a CD. Hopefully that answered that question. All right, another question. Rhonda, I got a fixed 7-year annuity from me. Thank you. I'm happy to have a 7-year rate of over 5%. Oh, Rhonda, I'm the only one seeing this. I typed that as not a ploy. I did read it, not knowing what it said. So yes, that's the point. Jane asked the question early. Thank you, Rhonda, about rates. Is that generally, or Jim maybe asked it, generally in an inverted yield curve, what happens is the short end goes down, and many times the short end and the long end goes down. And if that happens, locking some of your money in for longer is a really good idea. It really is. And then how long, it just kind of comes down to you again and your liquidity. I was talking 3 to 5 years, but in certain individuals like Rhonda, for example, had other sources of monies and other things come and do all the different times that she could go out a little further and lock in her money for longer. It's not that she got the higher rate, she got the highest rate available. It was a very good rate, but we weren't doing it for the rate. What we're doing it for is we know this inverted yield curve that Jim had asked about earlier, where short rates, short-term loans cost more than long-term loans. Again, I know I've given this a number of times ad nauseum. I don't want to bore everybody, but next question was Hank, and it goes right to this. Does an inverted yield curve indicate a recession is on the horizon? It indicates that there's a likelihood of a recession. Absolutely. Has every recession had an inverted yield curve in front of it? Yes. Has every inverted yield curve resulted in a recession? No. Recessions are the subset of those inverted yield curves. It doesn't guarantee it. It just means it could happen. We go back to this inverted yield curve right there. So, okay, we were talking about this, locking out for longer. I think I lost my train of thought. But if this whole thing comes down, let's say the whole yield curve goes down like this, you're going to wish that you'd locked in some of your money for longer. I still think that there'll be indications of that. That's when we'll know kind of if we're going into a recession or not, too. I'll be quite honest with you, Hank, is that if all interest rates start to collapse across the board, the Fed starts lowering interest rates by 0.5% or 1%, that's when I'd be leery about a recession. I'm pretty sure when the Fed comes out tomorrow and says what they say, they're not going to be talking one iota about lowering rates at the end of this year. They're not going to mention that. Now, the pundits, meaning the news people who are trying to sell hot dogs and Chevys on TV, those people will start to talk about it. They'll go, oh, well, this doesn't mean this is the last one. I think the Fed's going to make it real clear that they're not saying that this is the last one and they're open to raising more. They'll say nothing about cutting rates. Now, everybody else will be talking about cutting rates, but they won't. So we'll have plenty of time, Hank, to see if there's a recession coming. The other thing to understand is the markets and the economy are not in lockstep. It's not your lovely wife you go walking hand in hand with, Hank, probably every night when you guys go for a walk. The economy and the stock market are separate entities. The stock market going down last year gave me the recession and me the indication at the beginning of the year with the inverted yield curve. I thought if we're going to have a recession, we're going to see it in the first 6 months of 2023. We didn't have it. That's why I was pretty conservative with the money, kept a lot of it in T-bills and slowly adding into the markets. But now as we're getting into the second half, and we didn't get the earnings recession. The words were earnings recession, meaning that corporate earnings, because we're in the high part this week in particular, is the big tech week for earnings, right? I mean, we're seeing all these earnings coming out every single day right now. The banks were first, and now we're into the tech stocks, et cetera. So when is it coming out? This is Tesla. Yeah, they came out already, and there was 20% earnings growth. You know, I guess that was the other day. So that earnings recession never happened. It never happened. And oh yeah, it's going to come. These are the people who missed the stock market, rode it all the way down, and now they're going. You know, maybe they sold at the end, and they're partially coming back, and they're still upset. You know, that's just predicting a recession, not people who are actually watching what's going on. Yeah, we've had this inverted yield curve for longer than ever I remember. I've been doing this 35 years. So, but it doesn't mean for sure it's a recession, all right? The other risk mitigation strategy, I know we're getting close on time. I do want to do this for your risk money, is that if you have risk money, you want to do something like this. And many of you are my clients saw this. The best way to make money over time, with this being time and this being money going up, is to buy a stock at 20 and then watch it go up and sell it at 30. Easy, lessons done, no mitigation strategy. Yeah, but what if the day you buy, instead of going from 20 to 30, goes to 18, 15, 12, down to 10? What most people do then is they hope. They go, well, I can't sell it now. I hope it comes back. Oh gosh, I don't ever want to take a loss. If you don't want to take a loss, please don't ever get in the stock market. You shouldn't have any money in there. Seriously, you don't have the temperament for it. So the mitigation strategy is to put a safety net under the market, maybe within 10%. So if it goes from 18 to 20 before getting rich, you're out of it. And nowadays it's zero cost to buy and zero cost to sell. So your cost of insurance to put the safety net in there called a stop loss is zero. See, it's not predicting outcomes. I'm going to buy something that's going to go from 20 to 30. Some of the time I will, but I don't want to buy things that go from 20 to 10. Well, if I held some things long enough, some of the times it would. So why not, if it goes up, be happy, but if it goes down, have a mitigation risk strategy that protects your money that costs you nothing, because you can't predict the outcome and you must control the risk. No different than if it goes up from 20 to 30. Now you put your stop loss maybe at 25, so you have a 25%, profit protected. Even though you're up 50%, 20 is up by $10 to 30. 10 on 20 is 50% profit. So you can raise your stop loss as quickly as possible to what you paid as it goes up and keep raising it. So people ask me all the time, well, what if it goes down to my stop loss, say it's at 25, and you sell it? What happens if it goes up? Well, if it goes up without you, you lose opportunity. But again, if you're closer in retirement, are opportunities more important or protecting of your nest egg, your real money? Because if it goes down, as opposed to going back up, you're losing real money. We trade off opportunity for real money with this management strategy to mitigate your risk. So banks, bonds, insurance companies, meaning annuities, and stop losses on your risks are holding individual bonds to maturity. Those are the ways to do it. Estate planning and wealth considerations are really important to update your beneficiaries. You want to make sure everything's titled in your trust. Very, very important. Last example before I let some of you go, because it's 4 o'clock. I know some of you guys are going to hop, and other people could stay on until I get done, which is I'm almost there. Is this. is that I sell insurance, life insurance, annuities, and that sort of stuff. I am the beneficiary on my mom's policy and was the contingent beneficiary when my dad was around on his policies. My mom was primary. There was an insurance policy, an annuity policy that my dad owned, that when he passed, I come to find out that my name and my brother's name as the other 50% beneficiary was not on that policy. Was I a bad advisor and didn't put my own name to get my dad's money should he pass and my mom pass at the same time? No, of course not. I had my name on there, my brother's name, but all these mergers and acquisitions, just like Schwab buying TD Ameritrade, insurance companies are buying each other all the time. Go out, do the work. If you need help, you can call our office. We'll help you. And Jim just said bank accounts should also list loved ones. Yes, Jim, excellent point. You want to make sure that the titles are correct, and you want to make sure that your beneficiaries are correct. It may not have been you. You may have put it down right even last year, but there could be some tech snafu, some genius that merged some data from one system to another, and that's how that stuff gets lost. Okay, so check that stuff out. Like I said, those of you who've got to go, hey, appreciate it. We'll be back next month. We're going to talk about RMDs, required minimum distributions. Some of you are going to go, hey, I'm not old enough for an RMD. Perfect. That's perfect. It's really designed for someone before you start taking your RMDs. If you're already on it, you'll get something out of it as well, I promise you. But that's next month. Tell your friends to hop on those calls. All right, so understanding taxes is really important as well, because they make a difference. A lot of people don't look at taxes. It's so important to understand how things are taxed. Who was it? Jane asked that question, am I taxed twice? No, you're not taxed twice. And then there's qualified dividends, there's ordinary dividends. What you want to do, it's not just picking the next, Microsoft, Apple, Amazon, at the IPO and making money. It's not all about that. Sometimes it's taking your portfolio and making it more tax efficient. There are ways for people to lower their taxes by just structuring their money a little different. You can either go tax-free with Roth IRAs, and you can use municipal bonds and insurance to some degree, or you can go tax-deferred using annuities and some other things like holding stocks, etc. Easy way is to put them in your living trust. Yes, Cindy, except for IRAs. Your living trust won't own the IRA. If your living trust is the beneficiary of your IRA, then you're covered. Yes, but other people sometimes with IRAs, they may not want to put the trust as the primary beneficiary because it'll go avoid probate, and it'll go directly with qualified money or with a retirement plan like a 403B or a 401k or an IRA. Those will go directly and avoid probate. But yes, another way is to make sure the title is to have your living trust be the beneficiary of your IRA or the owner of your other accounts, and then list the correct beneficiaries in there. And then Jane asked, will the Schwab change affect beneficiaries? Not supposed to, not supposed to. The only thing that's going to affect is your account number is going to go down by 1, and your online access will obviously change. And apparently, we're going to know ahead of time how to get online, not September 5th. We're all going to have that out ahead of time. And then if you have direct deposit, money coming out that's going to your bank account, we will have to repay for that. If you need, let's say, 10 grand and we normally send it right to your bank account, that's going to have to be redone. So it's important to have some tax planning in mind, because it's not what you make, it's what you keep that counts. And that's what's really important. And so when it comes to your money, we've talked about how important it is to have a strategy that focuses on things that can either guarantee a portion of your money or create income that's more predictable. If you want to use risk, there's no problem with it, but I'd have a risk mitigation strategy by using a stop loss. There's another way to do it using options. Yeah, but it costs you money. So again, it's not, the years we've lived, but making your years count. And these strategies and insights are not just about securing your finances. but about offering peace of mind. Financial security is not the end goal, but it's a tool that allows you to live on your own terms. So I want to navigate this journey with you. I appreciate you spending your afternoon. If you have anybody else that can benefit from it, just forward the email or send us an email. We'd be glad to put someone on this thing for our next webinar in August. Let me see if I can pick the date out for you. It is the 23rd, and we're going to talk about RMDs 3 to 4 West Coast time. Never too late to plan for the future. You've been as remarkable as each one of you are. Thanks for your time, your attention, and your trust. And we will see you next month. If anyone has any questions, give us a call, 949-219-0692. Thanks again for joining me here today.